Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the unemployment rate holding steady at 4.2%. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So, we've actually had a fairly decent week in terms of the labor report numbers. There are a couple of weak things like the ADP, but the ADP historically hasn't really been a great indicator as to what we're actually going to get with the labor market data on Friday today. And again, it wasn't really a good predictor of that as well. But if you go look at the unemployment rate, you can see that it actually held steady here, right? It actually held steady. Kind of similar to last year, although maybe it's delayed by about a month or so. You can see the year before 2023, or sorry, 2023, we had a high here, came back down sort of into the early part of 2024, and then it went back up to around that 3.9% level, held there for a few months, and eventually it inched higher a little bit. Kind of a similar thing, right? But it's definitely playing out over a much longer scale, if it in fact is even going to follow that. The only difference between now and back then in terms of monetary policy is that we've had lower interest rates, right? Since then. Back then, the Fed funds rate was about 5.5%. Today, it's actually a lot less, right? They dropped interest rates down by about 100 basis points. And so that could obviously be having some effect. In fact, the interest rates started to go down right around here, September of 2024. We could break this down. I mean, this is just anyone greater than older than 16 years. You could break it down into sort of subcategories and look to see what's going on. 16 to 19-year-olds, unemployment rates at 13.4%. That might sound really high, but in the grand scheme of things, it's not really for that age group. And really, even where it is kind of low, given where it's been for the last like 50 or 60 years. This is some of the lower levels that it's seen over the last 56 years, despite the move higher. You could go look at 20 to 24-year-olds and see that that's at about 8.2%, right? That's at 8.2, and it is back up to near where it was back in February, but not quite. And then if you go look at, 25 to 54-year-olds, that's where the unemployment rate comes in a lot lower at 3.6%, right? And that's that age group, right? So when you combine everyone, you get an unemployment rate of 4.2%. Maybe applying a moving average could help, say like a 3-month moving average. You basically what you're seeing is sort of a run up in the unemployment rate, and then it kind of like steadies out in Q4 going into the next year. And then we saw the same thing happen again, right? It ran up and then it sort of steadied out as we got into Q4, going down into the next year. And it looks like we're just sort of in a slow progression to the upside, although it is really slow, right? I mean, it's admittedly very slow. And as always, when you get data like that, that's good. Well, a lot of times risk assets will use that opportunity to at least push higher in the short term, right? Because as always, right, markets don't need a reason to go up, they need a reason to go down. And because people just naturally buy assets, and so they go up. Now, if we go look at the unemployment level, that's a little interesting because it actually has continued to go up from 7.05 million to 7.08 to 7.17, and now 7.24. So the unemployment level does continue to increase, right? The unemployment level does continue to increase. It's higher than it's been, I guess, since when was the last time it was at 7.24 million? You have to go all the way back to October of 2021. And if you apply a moving average to it, I mean, it's just a slow, steady incline. And one of the things to note is that during prior, say, recessions, you've had very parabolic rallies in this metric. And, while it has gone up, it's mostly been contained, right? Like there's been these rallies in the unemployment level, but then they sort of steady out in Q4. We saw that in 2023. We saw it in 2024. My guess is it's likely going to go higher over the summer. The summer tends to be a pretty weak time for the labor market. We'll talk a little bit more about that later. But that's where it is right now, right? So we're getting the data for May. Okay, so next month we'll get the data for June, sort of the beginning part of the summer. Now, it's always interesting to check in with the unemployment level by reason for unemployment, okay? Because job losers really didn't go anywhere, right? It stayed relatively flat. And note that in prior recessions, that is something that has gone up quite rapidly. That has not gone up rapidly up until now, right? It hasn't. There are some things that have gone up rapidly. For instance, new entrants to the labor force, right? That's gone up pretty quickly. And even re-entrance to the labor force, has been moving higher. But what this tells us, and we've talked about this before, and it's evident in a lot of other data as well, what it tells us is that the main reason that the labor market was getting weaker at all was because people are just having a hard time finding new jobs, right? If you're a new graduate, if you left your old job, a lot of people are just having a hard time finding a new job. But the people that have jobs aren't really getting laid off at levels consistent with what we've seen in prior recessions. At least not so far. I mean, you can look at all these different metrics, right? You have permanent job losers. I mean, it's gone higher, but it's been mostly sort of a slow increase, right? Like compare this move here, this sort of slower move up. Compare that to what you saw in like 08 and 2000, where it was more of a rapid, right? The angle of attack on this metric back then was a lot more rapid than it is today. I mean, even in 2020, you can see it was a lot more rapid than it is today. This has been sort of like almost like it's just a slow, steady, engineered rise in job losers. Remember, the Fed wants to soften up the labor market. And you might wonder why. Well, the reason, at least the reason, I would say at this point, they don't want further softening. But the reason they wanted softening to begin with, one of the main reasons was, of course, wage inflation, right? Wage inflation leads to, increased demand and therefore just overall inflation, overall headline inflation and core inflation, all that stuff can go higher. And so by loosening up the job market, it actually allows to wage inflation to come back down, and that helps them fulfill their dual mandate of maximum employment. And also, that, of course, they want inflation to be at their target of 2%. So, this metric does continue to go higher, but so far it hasn't really gone higher in a way that has been problematic, right? It's just gone slightly higher, and it hasn't really caused a panic or anything like that. Now, you could always look at the unemployment rate per state, and I do like to check in with this every so often. Obviously, we always check in with Alabama because it is first in alphabetical order. It's just been constant at 3.3%, so that's actually lower than the national average, right? Only 3.3%. If you go over and look at, I want to look at different regions of the country. We're going to start off with California. California actually saw a big increase in unemployment, basically from 2022 until the beginning of 2025. But ever since 2025 began, the unemployment rate in California has actually been going down, sort of down and sideways. So again, some parts of the country, the unemployment rate is actually trending in a good direction, right? You're seeing fewer people losing their jobs. That's California. Now, if you go out to Colorado, it's a very different story, right? Colorado, the unemployment rate just continues to go up. In January of 2023, the unemployment rate in Colorado was 3%. In January of 2024, it was 3.8. In January of 2025, it was 4.7, right? So some areas of the country are seeing a rising unemployment rate, while then others are seeing a drop. And remember, in order to get a full-blown recession, right, which is obviously the topic that people are talking about, even Elon Musk just said yesterday that the tariffs will cause a recession in the second half of this year. We'll see. It is always possible. In order to get a full-blown recession, you have to see basically the entire country have a rising unemployment rate, right? It can't just be pockets. It has to be everywhere. It has to be widespread. And the reason for that is if it's not widespread, then the markets will look towards the areas that it's okay and choose to remain optimistic. Go look at the District of Columbia. This one's a little scary, but it makes sense, right? I mean, it makes sense. I mean, it was stuck at 5.3 for a long time. And then when Trump took office, the unemployment rate in Washington, D.C. obviously went up. We had all the Doge layoffs, right? So, I mean, that one makes a lot of sense as to why it went from 5.3 to 5.8. We know why, right? I mean, they were advertised, and that's exactly what they said they were going to do. Now, if you go over to, say, Florida, Florida has been one that has slowly increased, but it hasn't increased at the same rate as other states, right? It's been a really slow progression. But if you look at it, you can see that it started out at 2.8 in April of 2023, and then in April of 2024, it was at 3.3, right? So 2.8 to 3.3, and then now it's at 3.7. So again, we're seeing loosening in the labor market, right? It's absolutely loosening. And really, you can see that there's some areas of the country, the unemployment rate's going up despite the fact that they cut rates. So, I mean, you could argue that they should be cutting rates, right? You could make that argument if these are examples of what's going to come for the rest of the country. The problem is there's other areas of the country which look completely fine. And I think with the uncertainty around inflation as it relates to tariffs, that's basically keeping the Fed's hands tied. But if tariffs were not a thing, right? If tariffs were not an issue right now, you would look at the data. You would look at some of this data and maybe wonder, why they're not a little bit more concerned about this stuff. I mean, again, overall the country is okay, but there's definitely pockets of the country that are struggling more than others. One of the areas that actually, used to be doing relatively okay, the Northeast, is starting to see a little bit of weakening, right? Like Massachusetts, historically back in 2023 and 2024, I remember watching it. The unemployment rate there was very low. And I mean, while it was going up, I mean, it was still less than 4% for a lot of that time. It is starting to pick up, right? Like 4.1, 4.2, 4.3, 4.4, and then now 4.6. So some pockets are definitely starting to go up. But one of the reasons why we haven't seen the unemployment rate for the entire country go up is because some states is actually going down. Again, California, it's going down. So in order to get one of those full-blown recessions, right, which is what, again, people keep talking about, it has to be more widespread, right? If you have a big state like California where it's going down, that can help offset some of the states where it's going up. And we'll just look at a couple more just for completeness. Maybe we'll look at Texas. That's always an interesting one to cover. This is one that the unemployment rate really is barely moved. I mean, the lowest it got was 3.7, and then today it's like 4.1. The highest it's gone is 4.2, right? So whatever they're doing down in Texas is a bit different than what we see going on in a lot of the rest of the country, because in Texas, the unemployment rate really hasn't budged a whole lot. Not in a long time. Not in a long time. So, maybe the Pacific Northwest. Let's check in with Oregon. Oregon, you're seeing it go up. So we could go through all this, but there's an easier way to look at this, all right? And that's by looking at a map looking at a chart, and then we'll look at a map, right? So if you look at a chart, this shows you the number of states where the unemployment was rising compared to 1 month ago. We're at about 19 or so. But if you look at it over the last 6 months, you can kind of see that in 2022, there was a spike to 31 states, and then it went down, and there was a low of 5. And then it spiked again to 45 states. Again, the spikes occur around the same time, right? November. Spikes are in November, or around that time. So it first topped at 31, then a low of 5. Then it went all the way up to 45, then a low of 19. Then it actually went to a lower high, right? 43. I mean, it's hard to get to too many higher highs from here, right? 45 states. There's only 5 more states. So I think in this case, we're also including, you can include Puerto Rico and the District of Columbia if you want. But we're only looking at these 50 states. And so it's hard to get too much of a higher high unless it is the entire country. The low that we got here in March is slightly higher than the low from last year in April, right? From 19 to 22. So my guess is that we will see this start to go back up into November. You guys want to know something really interesting? You guys know how the last couple of years, how there's been a rally by alt Bitcoin pairs starting in November. You see this here? Like this rally right here started in November, and then this one over here also started in November. These two big rallies by alt Bitcoin pairs. That actually corresponded to when the number of states with a rising unemployment started to top out, right? And things started to look better. And when things start to look better, the frothier stuff starts to do better. Okay, so this is a really interesting chart. Now, if you're just curious about your state, sorry, I don't have the rest of the world, but if you're just in the United States and you just want to know what your state is doing over, say, the last 6 months, these are the states with a rising unemployment rate compared to 6 months ago, right? So the Northeast is starting to look a lot weaker than it did previously, right? Back in 2023, this looked fine, okay? Even if you go to, say, last year at this time, the Northeast was okay, but it was out west where the unemployment rate was going up and throughout the central part of the country. So what you'll see here is if we just sort of play this, if we play this from starting 2021, you can see it's never really been the entire country, right? There's always been pockets where it looks okay. There's always been pockets. Now, compare that to a recession, like a massive recession, like the financial crisis. Back then, it's the entire country, right? I'm not really sure. There we go. It was the entire country. Now look at the dot-com era. It's the entire country. So in order to see those full-blown recessions, it has to be the entire country. It can't just be pockets, because if it's just pockets, then by the time it stops raising over here and that goes down, then maybe it'll go back up over here, but the markets will look for the positive side. We can also look at alternative unemployment rate measures, job losers. Again, not a whole lot to discuss. I mean, this is kind of similar to what we already discussed previously. And then I'm just going to show this chart just for the sake of completeness. People not in the labor force. We'll look at a year-over-year percentage change if you're curious. Now, let's get into some other stuff. Some of these charts I don't really talk about a whole lot, but I'll put them on here in case you're curious. Here's the labor force participation rate. Here is the civilian labor force level. This is actually something that dropped a lot, 625,000. So if you're wondering like how the number of unemployed people was able to go up, but the unemployment rate's not really going too much higher. One of the things to consider is that the overall labor force level dropped by 625,000. If you go look at the employment level, this actually increased by 139,000, so it beat expectations. Although, of course, the caveat to that, and the thing that everyone complains about on Twitter all the time, is that they tend to revise the last month down, which is what they did again, and then the current month is a beat. And it kind of happens over and over and over again. So like every time they release it, they'll revise the last month or two down like negative 90,000, and then the current month will be a beat. So hopefully the markets just focus on what's happening this month. But that looks pretty good. I mean, it's still continuing to go up. Household had a pretty big drop, right? So household actually dropped by 696,000. So that was actually a decent sized drop, and we'll talk a little bit more about that later probably. If you look at the non-farm private payroll employment level for total private, it went up by only about 37,000. This is based on the ADP, the automatic data processing. A lot of people don't put as much weight into this one as the one we just checked out, the employment level. But note that at least in a year-over-year time frame, this is starting to roll over a little bit. Still well above zero, right? Still well above zero in terms of the year-over-year change, but it is, starting to roll over a tiny bit. You could go look at construction and see a year-over-year change, right? Some of the construction stuff, we're starting to see some weakness there. I mean, again, it's not like we haven't seen this before, but we are starting to see some weakness in some sectors, while in other sectors, I believe manufacturing, while it's still negative, it's becoming less and less negative. So some sectors of the economy are starting to look better, while other sectors are starting to look worse. And that could explain why the unemployment rate is very regional, right? Like some parts of the country are, say, more geared towards like manufacturing, whereas other parts of the country might be more geared towards like the tech industry. And that could be one of the reasons why the unemployment rate looks very different in different parts of the country. Total temporary help service employees. This is kind of an interesting metric because it's basically just been dropping since March of 2022. You know, it looks like it has put in a new low. So that actually continues to roll over. You can see that it bounced right around the same time that they started to cut interest rates, but that bounce is now over and now it's putting in new lows. Again, looking at a chart like this, it might suggest that a rate cut would be somewhat timely, right? But with that said, it doesn't look like they are going to cut rates. I mean, at least not as far as I can tell. I mean, unless they throw us a curveball. But I mean, you can see right now, we're basically locked in for a pause at the next meeting, which is June 18th. And there's also a really high chance they're going to keep rates paused in July. In fact, the month that might give us a rate cut, assuming the markets stay somewhat well behaved, is not until September. So keep that in mind. Not until September will be the next rate cut. And I mean, I think there's a good chance we'll make it through at least the next meeting or two without a rate cut, because a lot of times in the summer, there will be a lot of volatility compression where the markets don't really go anywhere. Or they're just either going sideways, maybe slightly trending up, maybe slightly trending down, but not really a ton of volatility. And if there's not a lot of volatility, then the Fed's probably going to elect to play it safe. I'm not saying they should, but I'm just saying that that's what they're probably going to do rather than try to predict where things. I think the main thing holding them up, I think, is just how are tariffs going to influence the inflation data. Because I think if you were to look at some of the data, you would probably argue that getting another rate cut or two could be timely. I mean, especially we're seeing other parts of the world, continue to cut rates. But obviously the U.S. is not really following along right now. And we'll talk a little bit more about that in a few minutes. If you look at multiple job holders, we're just going to throw this on here. That actually got a pretty big drop the last couple of months. Again, I don't know necessarily there's a lot of weight to put in this data. I mean, it's a very volatile data set, but I'm putting it there in case you want to follow along. Job postings on Indeed also kind of shows that maybe the rate cuts that we got sort of ran their course. If you look at like job postings, you can see they bottomed out around the time that we started getting rate cuts. We got a little bit of a bounce, and now they're just going lower again. So again, it's one of the suggestion that perhaps another rate cut or two would be somewhat useful. I'm not talking about for the markets. I'm more so talking about for the economy, right? I think another rate cut or two could be somewhat useful. I'm not really talking about, 100 basis points or anything like that, but 25 basis points, 50 basis points. I think they could get away with it, but I don't think they're going to do it, right? I don't think they're going to do it just because I think they're actually going to be somewhat stubborn on this. And I think the reason is because Powell is determined to stay the course until he is sure the job is done. He's not going to try to predict what's going to happen. I think he's going to stay the course no matter what until he looks at the data and says inflation is done, right? For this, like, it's not coming back in the short term. And I think that's what they're going to continue to do. Yeah, so you can see that if it's indexed here at 100 pre-pandemic, and it's getting back close to that level. Some of the categories look a lot better than others. Like childcare is still above pre-pandemic levels. But look at where was it? It was the computer science. I don't remember how they have it labeled on here. But some of these have not really looked that great. Software development, look at software development. Just it's even below where it was in sort of the pandemic crash. Like, obviously a lot of this could have to do with AI. But I mean, yeah, that's a really big drop. And I think that could be a problem that we sort of face in the coming years whenever they do cut interest rates a lot more. What if they cut rates and then people still don't hire as much? And maybe that's sort of the the future, like, oh crap moment whenever that happens. And again, this could be a long time off, right? But the idea of, like, you get really aggressive rate cuts, but companies are still not hiring because, well, they have all these AI tools that'll allow them to do the job they need, and they don't have to hire people. So again, I think that, to try to remain optimistic, I think that AI will likely lead to the creation of new jobs, but there also could be a transitionary period where we go from sort of removing a lot of old jobs before we figure out what all those new jobs are even going to be. But again, I mean, nursing, if you look at nursing, it's still well above pre-pandemic levels. If you look at IT operations, that's below pre-pandemic levels. I feel like a lot of this AI stuff with computers and that kind of stuff is potentially taking a hit with some of the job stuff. And we go look at construction, also above pre-pandemic levels. So again, some industries have been hit a lot harder than others. If you look at the employment to population ratio, it's starting to come down a little bit, but nothing too scary at the current time. It is negative, but there's times where it has been negative, where the markets have been relatively okay. It just, I mean, it hasn't really gone that negative, right? Like, there's periods where you'll see it go negative, but unless it's really dropping, say to like -1 or -2, it hasn't been as big of a concern for the markets. And right now, it's only right around -0.4. Job openings. So job openings actually went up 191,000. That's good to see. We'll see if that can continue. And job openings is also very industry specific. Like, construction has continued to trend down. Retail trade has started to go back up a little bit. But also retail trade got more annihilated previously. And then manufacturing, that one just continues to fall off a cliff. So job quits rate went down a little bit. Remember, job quits, you don't want to see it go down, because if it's going down, it means people are less likely to leave their job. And they might be less likely to leave their job if they're uncertain about finding a new job, or if they're unable to find a new job, right? So the job quits rate dropped from 2.1 to 2%. And again, you can see that dropping is normally not a good thing, but the one thing to consider is, despite this big drop, it still is at levels that are relatively healthy, at least historically speaking, right? Unhealthy levels would be, say, well below 2%, right? Like, you're talking about like 1.4, 1.5, 1.7. Those might get to some unhealthy levels, but for now, it's still holding on. Layoffs are still relatively low. They did go up, but again, I know there's a lot of headlines about layoffs, but in the grand scheme of things, I mean, this is just a return to normal, right? I mean, even in healthy economies, there's always going to be layoffs. There's always companies that are trying things and failing and sort of restructuring, and people get laid off. So yes, there have been layoff headlines, but you can see that we're just back to normal right now. That doesn't mean we won't overshoot, but so far we've just gotten back to normal. I think in order to see the Fed really aggressively cut, there would need to be some evidence that this is going to continue to go to the upside and they've actually overdone it, which at this point isn't exactly clear. Initial claims have started to rise, and this is something we've talked about before. We said to expect initial claims to rise into the summer. This is something they did last year. They rose into the summer, and then they also did the year before as well. Okay, so this is relatively normal. If you look at a 7-week moving average, you can see that we are putting in higher lows with initial claims sort of at the beginning of each year. But last year, it was sort of a lower high. We'll see what happens this year. It does look like it is really starting to accelerate. But as always, I think the labor market is okay until initial claims hit 300K. If they hit 300K, if and when, I think that's when we have a problem on our hands in terms of the labor market. We also could look at initial claims per state. This is obviously not seasonally adjusted. If you look at the number of states where initial claims over the population is greater than, say, 0.1%, still relatively low. The only thing that might be somewhat of a concern is that it looks like, is it turning the corner here where, it was putting in lower highs, and now is this the first higher high? Again, it's a multi-year process, but perhaps keep an eye on that. Initial claims map, so this is normalized by population. The weakest areas of the country in terms of initial claims are up here in the north, and also out west, and also in Kentucky, I guess. the number of states where the percentage year-over-year initial claims is rising is still relatively low. I mean, it still looks more like what you might have seen in like the mid 1950s, at least so far. It hasn't really gone up into those major increases just yet. Map of states, percentage year-over-year initial claims rising more than 30%. Again, not many states. If you look at it, say over only 10%, it's a few states, but compare that to recessions and you'll see like why the market has not really cared, right? Like this is what it looked like in '08, and then look at it today, right? So you can see the difference. Continued claims continues to go up, but at a very slow pace, right? In the grand scheme of things, it went up a lot back over here in 2022, and it's mostly been flat since then. You could apply like, you know, a 14-week moving average and see that it's slowly going up. But even with all these increases, I mean, the levels that it's at now are basically the lows of prior recessions, to give you an idea. And also, it hasn't moved up in an uncontained way, right? Like it's been a slow and steady increase, nothing like what we saw in these major recessions of the past. Continued claims map, where you know we see it go up, normalized by population. Again, most of the country seems still fine. And here's a number of states where the percentage year-over-year continued claims is rising by a certain amount. Let's go to 10%. Still relatively low. There was a spike back in 2023, but it hasn't really spiked back up there. And then here's the map in case you're curious, and we'll switch this to 10% in case you want to see like where is it getting harder to find a job. Sort of out here, the sort of the central part of the country, and then also over here, sort of on the east, on parts of the East Coast, but not the entire part of the East Coast. Hires actually has gone up. This is one of the better looking charts. Hires is actually higher, no pun intended, sorry, than it has been really since like, I mean, it's basically back to where it was in May of 2024, in April of 2025. So at least hires has gone up. That's a good thing, right? Like that's a good thing to see, even if not all the other data is as optimistic. And that's basically what I want to cover with the labor market. There's a few other things we could look at. We could go look at some of these indicators, like the smooth recession probability indicator. It's still relatively low, right? The odds that we're in a recession as of April 2025, only about 0.5%, so not really that high. We've got the real GDP recession indicator. It's gone up a little bit, which makes sense because last quarter was negative. We had negative GDP. It's still relatively low. The SOMRL recession indicator, we had this sort of this fake out right here where it signaled, but then it's back down here. The only other time in history where it did that was way back over here in 1959, where it had a signal, and then we came back down, and then we did get a recession, although you can see the market, the stock market, wasn't really that bad during that time, but we did get a recession, but it took a little bit longer time to get there, right? So we had that sort of the fake out in Q4 of 59, and then we actually got a recession in Q4 of 1960. This fake out was in sort of Q4 or Q3 of 2024. It's come back down. We'll see if it goes back up. My guess is it probably will going into the summer. And for the reasons we mentioned, right? Like the labor market tends to just weaken in the summer. We normally see initial claims go up. We likely will see the unemployment rate go up as we get out into the summer. But, you know, it doesn't have to necessarily be like as bad as some of the prior recessions of the past. Number of states where the SOMRL has triggered, it's actually been dropping, so that's good to see. There are times where it'll go up and it doesn't really trigger a major recession, so that's good to see. The map of states where the SOMRL has triggered, in case you're curious. And then we have the composite leading indicator. This is one that has started to roll over, so I have started to watch that one a little bit closer recently. You don't really want to see it roll over. It sort of looked like it was going to roll over back over here a year ago, and then it just picked back up going into August. So maybe it'll do the same thing, but it is starting to go down. Okay, so keep an eye on that one. We've got the National Financial Conditions Index that continues to drop. This one was interesting because we did get a spike, but it makes sense because we had that pretty large drop with whole tariff stuff. Let's back down. The Coincident Economic Activity Index continues to go up at a somewhat solid pace. I mean, a year-over-year change shows that it's still relatively fine. The Economic Policy Uncertainty Index had increased a lot with all the tariff stuff. So, you know, I mean, that was higher than it's really ever been, I think. It has been dropping, though, right? It has been dropping. So that's good to see. I mean, you can see that there's other times where you get these big spikes with this stuff, and markets don't like uncertainty, right? Markets really don't like uncertainty. So when you get when you get these big spikes, that it makes sense that that's where the markets will really start to struggle because they really, really hate uncertainty. That's about it. I think that's about it. The only other thing, I guess, is if you go to the workbench and you look at the job openings per unemployment level, or per unemployed worker, it's still above 1, right? So it's currently at 1.03. So according to this, there's 1.03 job openings per unemployed worker. Powell has mentioned this metric many, many times. Perhaps he'll start to get a little bit more dovish whenever this metric goes below 1. Because when it's below 1, it means there's not a job opening for every unemployed worker. But it's basically just been hovering above 1 for about a year now. Right? For about a year. That'll wrap it up for the video. That's your labor market report for the month. Again, we'll see where it comes in next month, but that's what's happening this month. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.